Income versus cash flow. Operating cash flow. Did you know that there are only four ways to earn money? Not 40, not 400, but four. Most of us have probably heard of Robert Kiyosaki's book, Rich Dad, Poor Dad. But what most people don't know is that Robert Kiyosaki actually wrote part two of Rich Dad, Poor Dad, which he called the cash flow quadrants. And it breaks down the four different types of income, how they work, and why this is why the rich keep getting richer. Each one of these categories has three components: mindset, cash flow, and taxes. Hello everyone, and welcome to our channel. Before we begin, please do us a huge favor and click the subscribe button below this video. Let's get started. The E quadrant comes first. The letter E stands for employee, and this is where most people begin. A person's mindset in the E quadrant is focused on income security and employer benefits such as retirement accounts, health insurance, and a consistent paycheck. The employee's top priority is safety. The security of a consistent paycheck is more appealing to the E quadrant mindset than potential riches that may come at a higher risk. As a result, the keyword for the E quadrant is safety. People in the E quadrant earn money by working for a company or the government and exchanging their time for a set amount of money, whether it is salary or an hourly wage. People in this category can still make large sums of money, such as a doctor, lawyer, or executive, but the limitations in this quadrant make it difficult to build wealth in this quadrant alone. In this quadrant, an employee typically does not have much control over how much money they will be paid, making increasing their own income more difficult because their boss controls their salary and the decision to increase their employee's income. A person in this category can only rely on themselves to make money, and there are only a few ways to increase their income, which is usually to return to school and find a better paying job. Then there are taxes. Taxes in this category are very straightforward. An employee works, taxes are deducted, and the employer receives their pay only after taxes have been removed. There is very little a person in this category can do to reduce their taxes. The most someone can do in this category is to defer some of their taxes for later, such as when they put money into a retirement account such as a 401k or a traditional IRA. Someone in this category is required to pay federal income tax, which can reach 37%, state tax, which can reach 13% depending on the state, as well as local taxes, social security tax, Medicare tax, and so on. For high earners in this category, their tax liability can reach 40% or more in their income. The S quadrant represents self-employment or small business. This is when someone decides to try their hand at entrepreneurship and generate their own income. An S quadrant mindset is to reclaim control and the freedom to pursue a higher level of compensation than they would working at a job, so they decide to become an entrepreneur. Independence is the keyword for the S quadrant. In this category, money is made by exchanging time for money, but instead of exchanging time for a fixed amount, the self-employed exchanges time for the possibility of profit. People in this category take a higher level of risk than those in the first category because there is no guarantee that they will make any money. It all depends on your ability. They must sell their products and follow through on their promise. However, just as some people cannot make any money in this category, others can make a substantial income. However, again, it all depends on their ability to sell and deliver. Taxes in this quadrant have a little more flexibility because people in this quadrant can deduct work-related expenses as tax write-offs. But people in this quadrant still have to pay income tax, state tax, and local tax if applicable. However, the self-employed end up paying more money in Medicare and Social Security taxes than the first category. This is because when someone works for a company, the tax is split between the employer and the employee, with each paying half. However, when someone is self-employed, they are acting as both the employer and the employee, which means they are responsible for both sides of this tax liability. The B quadrant represents big business. The rules of the game are a little different in this category than in the previous two, creating an environment in which exponential growth and wealth becomes more achievable. A person in the B quadrant's mindset is to use leverage to exponentially grow their income. There are two types of leverage that are commonly used in this category. OPT, and OPM. That means other people's money and other people's time. People in this category want to maximize a business's results, so they look for other people who can effectively run parts of their business so they can focus on growth and further expansion. The day-to-day operations of the business, unlike self-employed, are no longer part of the B quadrant schedule. However, the day-to-day operations are handled by a system or someone else. Leverage is the keyword for the B quadrant. At its most basic, big businesses make money in the same way that someone in the S quadrant does. They must be able to sell a product or service and deliver their promises, but the goal is to do so on a large scale. The entrepreneur in this category is no longer exchanging time for money or profit. The entrepreneur's time is used to create a system that can effectively manage other people's time and resources in order to maximize cash flow for the company and its investors, and this system must work independently of the entrepreneur. As a result, the company is cash flowing assets. When a business becomes an asset, many owners decide to keep it and hire someone else to run it, to take the company public and sell shares to other investors, or to sell the entire business. Because independently operating businesses that generate consistent revenue are very appealing assets for larger investors, taxes work very differently in the B quadrant than in the previous two categories. To begin with, corporations have a maximum tax rate of 21%, and owners of these companies frequently choose to pay themselves the majority of their profits and dividends rather than a large salary. This is due to the fact that dividends are taxed at a maximum rate of 20%, whereas salaries are taxed at a maximum rate of 37%, not including state, local, and social security taxes. Businesses can also relocate to take advantage of more advantageous tax laws. Why do you believe so many business people relocate to Puerto Rico? It could be the tropical beaches, or it could be the fact that Puerto Rico has 4% corporate tax rates and no income tax, capital gain tax, or dividend income tax. Debts become an asset due to the tax laws in this category. Companies can use debt to spend more money on growing their business than they actually make profits, leaving their taxable income to be zero, or even report a loss that can then roll over to reduce future tax bills. Not only that, but businesses can roll over debts into new debts. Because they keep using new debt to pay off old debts, businesses can effectively postpone debt payments indefinitely. Companies can also take advantage of write-offs and credits available only to businesses and institutions. Because there are numerous tax credits available to businesses, this is an area where they can get really creative. Donald Trump is one of the most outlandish examples of tax evasion. After his first wife died, Trump buried her in one of his golf courses, which seems like an odd choice until you realize that this qualifies this golf course as a cemetery, and cemetery land is exempt from all taxes and assessments under New Jersey tax law. This means that Trump's single action resulted in a tax avoidance in trifecta, in which he eliminated three different types of taxes: property tax, income tax, and sales tax, all in one shot. The I quadrant represents the investor. This quadrant is where money is transformed into wealth. The great thing about the I quadrant is that regardless of which quadrant you are in, anyone can become an investor and benefit from everything this quadrant has to offer. However, the cost of entry to become an investor is capital. The methods by which people obtain this capital vary. Some people use their jobs to generate income, which then they would save and invest. Others may have come up with other inventive ways to obtain capital or collaborate with someone who already has it. The I quadrant's mindset is detaching time for money and collecting assets that provide income without requiring the investor's time. In many cases, the investor still uses some of their time to manage their investments and make decisions, but the person's time is no longer required for income to be generated. The creation and preservation of wealth is the goal of someone in this category. People can become wealthy in the B quadrant, but they can only achieve long-term wealth by becoming effective in the I quadrant. Wealth is the keyword for someone in the I quadrant. There are numerous ways for people to build wealth in the I quadrants, including traditional stock investment, business ownership, real estate investing, private equity, and so on. However, there are three fundamental wealth builders that investors look for. The first one of these is cash flow. This is the income that assets provide to the investor, whether it is ownership in businesses that generate consistent revenue or real estate property that generates rental income. The goal is to have your assets generate positive cash flow that allows you to finance your lifestyle. Number two is appreciation. This is the increase in value and growth of an asset over time. Aside from cash flow, you want your assets to be worth more tomorrow than they are today. This not only provides incremental wealth, but also leverage to play around the I quadrants. And number three, taxes. The I quadrant offers numerous tax advantages that other quadrants do not. One of these advantages is the ability for investors to grow their wealth to higher levels virtually tax-free. One of the most well-known examples of this is in the field of real estate. In the world of real estate, there is something known as 1031 exchange. This enables investors to profitably sell an asset and defer taxes in order to use the proceeds to purchase additional property. Typically, taxes are deferred until the next asset is sold, but many investors simply continue to use this strategy and roll over their profits from one asset to the next larger asset without paying any taxes. This allows investors to virtually tax-free increase their net worth. Many investors who do not want to sell their assets can simply borrow money and use those assets as collateral to buy more assets, allowing them to take control of even more wealth. According to Robert Kiyosaki, the I quadrant is like a playground for wealthy people. And just as important as knowing the benefits of becoming an investor is learning how to invest, which is what truly makes someone wealthy. If you like this video, please give us a thumbs up and share your feedback through the comment section below. Also, don't forget to share it with your family and friends. Thanks for watching!